Okay, that was annoying. I accidentally pushed the power switch on the thing that films the document. What I was doing is I was finishing talking about open market operations. So I was talking about if the Federal Reserve sells bonds, that's going to push bond prices down because it's adding to the supply of bonds. And we know that interest rates and bond prices move in the opposite direction. So lower bond prices, we could equivalently say higher interest rates. Okay, so that's one of the Fed's tools, and it is the number one most important tool, the open market operation. There are some other things that the Federal Reserve does, and one of them is that they can change reserve requirements. So remember that the strength of the bank money creation process depends on the reserve ratio. And in particular, the bank money creation process is stronger when reserve ratio is low, because the multiplier is 1 over the reserve ratio. And a small number here on the bottom means the bank money multiplier is large. So if the Federal Reserve lowers the reserve ratio, that is going to produce an increase in the money supply. On the other hand, if they increase the reserve ratio, that's going to make that bank money multiplier smaller, and that's going to decrease the money supply. This is not actually a very frequently used tool. It's very sort of blunt and disruptive, and the Federal Reserve doesn't tend to do it very much. So, although the Federal Reserve could do this, that's not how they usually choose to do it. There is also what's called the federal funds and discount rate. And these two tend to actually sort of get confused in a lot of people's minds. The federal funds rate is the interest rate banks charge each other to lend reserves. So what happens is that each bank is required to keep a certain amount of money on reserve at the Fed. So those cash reserves we had talked about in our earlier banking example are actually kept electronically on reserve, mainly at the Fed. If a bank falls below its required reserves, it's obligated to try and borrow excess reserves that some other bank might have. So this is actually kind of like an interest rate between banks. And it's actually not something the Federal Reserve has direct control over. What the Federal Reserve does have direct control over is what's called the discount rate. So if a bank can't find another bank to borrow reserves from, banks can apply to borrow reserves from the Fed. And the Federal Reserve gets to name its own price. Now, banks are extremely reluctant to do this. Essentially, if you go and do this, you're sort of announcing to the world that, oh, we couldn't find any other bank that would lend us money, which tends to raise grave questions about your creditworthiness as a bank. So, again, banks are very, very reluctant to do this. So this reserve rate doesn't actually come into play very much, but it is sort of the lender of last resort, how much the Federal Reserve is going to charge you for that feature. Typically what happens is the discount rate is significantly above the federal funds rate. so that banks have an incentive to try and borrow from each other and only come to the Federal Reserve if something else is wrong. And then there's kind of an extra penalty because this might be 1% and this might be 3%. So not only is there the stigma of going to the Federal Reserve's discount window, you also have to pay a higher interest rate. So the last tool of the Federal Reserve is one that other central banks have had for a number of years, but the Federal Reserve has only added recently in the wake of the financial crisis, and that is the interest rate on reserves. So for a long time, the Federal Reserve did not pay interest on reserves. And essentially that meant that banks wanted to keep as little on reserve as possible because they were missing out on the opportunity to make money by loaning those reserves out. Now the Federal Reserve has given itself the option of paying interest on reserves, and the way you want to look at this is a high interest rate on the reserves encourages banks to keep more on reserve. And if banks keep more on reserve, that's effectively like a lower reserve ratio. And a lower reserve ratio means that the bank money creation process is weaker. And that, in turn, means the money supply is smaller. So that's a sort of very long chain of arrows, but that's the way it would play out. If the Federal Reserve, on the other hand, has lower interest rates on reserve, then that's going to mean that banks don't have much incentive to keep excess reserves, excess beyond what they're legally required to. So they're going to have a higher reserve ratio. I messed this up here. I'm not sure whether or not I misspoke or just miswrote. I should have written higher reserve ratio there. Okay. So there we go. Okay. A low interest rate on reserves means that banks minimize reserves and that means there's a low reserve ratio, which means the bank money creation process is relatively strong, which means a larger money supply. So that's essentially how the interest on reserves works. The Federal Reserve hasn't really put that into practice much yet, but it's widely speculated that once the economy recovers and the Federal Reserve gets more interested in fighting inflation, as opposed to right now, it's mostly interested in fighting unemployment, then they'll raise the interest rate on reserves, and we'll see how this plays out.